We haven't gone more than a year without hearing bad economic news about the US, Europe, or Japan. The housing industry has collapsed, business revenues have decreased, unemployment has increased, and financial markets have been in a freefall. Is there a single phrase that adequately captures these developments? Well, yes. It's called recession. What exactly is a recession? What is the cause of it? Is it susceptible to prediction? How long does it last? How could it possibly affect you or me? These are the few questions that we will try to answer in this video. Welcome to yet another great video regarding money, wealth, and finance. Here, we highlight every necessary information, tip, and advice regarding finance, trade, and investments that you need to know. If this is your first time on our channel, kindly hit the like and share buttons and subscribe for more tips on money, wealth, and finance. Now let's get started. A recession is a protracted period of significant economic slump that can last for months or even years. Experts define a recession as a period during which a nation's economy has negative gross domestic product, or GDP, rising unemployment rates, dropping retail sales, and shrinking measures of income in manufacturing. Recessions are seen to be a necessary part of the business cycle, or the predictable cyclical pattern of economic expansion and contraction that distinguishes a nation. A recession is categorized by economic difficulties, job losses, decreased sales by businesses, and a reduction in the nation's overall economic output. Several variables determine when the economy enters a recession officially. According to a few general guidelines developed by economist Julius Shiskin in 1974, a recession is when a GDP starts to fall for 2 straight quarters. 2 quarters in a row of declining output indicates there are significant underlying issues because a healthy economy grows over time, according to Shiskin. Over time, everyone has come to agree on this definition as a recession. Recession starting and ending dates in the United States are officially determined by the National Bureau of Economic Research, NBER, which is widely regarded as the authoritative source. Recessions are defined by NBER as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Compared to Shiskin's criteria, the NBER definition of a recession is more open-ended. For instance, the coronavirus may have resulted in a W-shaped recession, in which the economy declines for a quarter, then recovers, and declines once more over the following quarter. Shiskin's criteria would not apply, however. The NBER definition may make this a recession. What triggers a recession and why? There are various ways for a recession to begin, including an abrupt shock to the economy or the consequences of unchecked inflation. Let's look at a few instances that are some of the primary causes of a recession. Technological advancement. There may be short-term periods of adjustment to technical advancement, but overall, new technologies boost productivity and benefit the economy. Numerous technological advancements that reduce labor were made in the 19th century. Recessions and difficult times were caused by the Industrial Revolution, which rendered entire professions obsolete. Some economists are concerned that automation and AI may trigger recessions by displacing entire occupational categories. Excessive debt. The expense of debt servicing can rise to the point where people or companies who take on excessive debt find themselves unable to make their payments. The economy is then turned upside down by increasing debt defaults and bankruptcies. A recession brought on by excessive debt was most prominently demonstrated by the mid-2000 housing bubble that sparked the Great Recession. Excessive inflation. Although excessive inflation is a risky occurrence, inflation itself isn't necessarily a bad thing. By hiking interest rates, central banks can control inflation, but doing so reduces economic activity. In the 1970s, unchecked inflation was a persistent issue in the United States. The Federal Reserve abruptly increased interest rates to break the cycle, which brought about a recession. Unexpected economic shock. An economic shock is an unexpected issue that causes significant financial damage. In the 1970s, OPEC abruptly stopped supplying oil to the United States, sparking a recession as well as long lines at gas stations. A more recent example of a quick economic shock is the coronavirus outbreak, which crippled economies everywhere. Extreme deflation. Deflation can be worse than runaway inflation in terms of its ability to cause a recession. Deflation occurs when prices drop over time, leading to decreased earnings, which further lower prices. When a deflationary feedback loop becomes out of control, consumers and businesses stop making purchases, which hurts the economy. A significant recession resulted from Japan's troubles with deflation over most of the 1990s. So what are the advantages during a recession? The average duration of U.S. recessions is monitored by the NBER. The average recession lasted 11 months between 1945 and 2009, according to NBER data. Over the past, this is an advancement. Recessions typically lasted 21 months from 1854 to 1990. There have been 4 recessions in the United States in the last 30 years. The Gulf War recession, July 1990 to March 1991. The United States had a brief recession at the beginning of the 1990s that lasted 8 months and was partially brought on by the first Gulf War spike in oil prices, the dot-com recession, March 2001 to November 2001. Several significant economic issues were plaguing the United States at the turn of 2000, including the effects of the collapse of the tech bubble, accounting scandals at firms like Enron, and the 9/11 terrorist attacks. A brief recession was caused by all of these issues, from which the economy swiftly recovered. Great Recession, December 2007 to June 2009. The significant fall in economic activity that began in 2007 and persisted for several years, affecting local and international economies, was known as the Great Recession. Since the 1930s Great Depression, it is regarded as the worst downturn ever. This recession was triggered when the U.S. housing market turned from a boom to a bust, and a significant quantity of mortgage-backed securities, MBS, and derivatives saw their value fall. The COVID-19 recession. The most recent recession began in February of 2020 and lasted only 2 months, making it the shortest U.S. recession in history. Can a recession be predicted? This is a natural question to ask at this point. It is difficult to foresee future recessions since economic forecasting is unpredictable. For instance, COVID-19 seemed to arise out of nowhere at the beginning of 2020, and within a few months, the U.S. economy had virtually collapsed and millions of people had lost their jobs. The coronavirus has officially been blamed for the U.S. recession, according to the NBER, which also noted that the U.S. economy started to collapse in February of 2020. Despite this, there are warning signs of impending trouble. You may have more time to make your recession preparations if you are aware of the warning flags listed. A drop in the leading economic index, LEI. The LEI, a publication of the Conference Board, aims to forecast future economic trends. It takes into account things like stock market performance, new manufacturing orders, and applications for unemployment insurance. If the LEI fails, potential economic problems may develop, rising unemployment. Without a doubt, it is a poor indication for the economy if people are losing their jobs. Even if the NBER has not yet formally proclaimed a recession, only a few months of significant job losses are a strong indicator that it's imminent. An inverted yield curve, the market value or yield of various U.S. government bonds, from 4-month notes to 30-year bonds, is represented on a graph known as the yield curve. Longer-term bond yields should be higher when the economy is running normally. However, it indicates that investors are concerned about a recession when long-term yields are lower than short-term yields. A yield curve inversion is a phenomenon that has previously been used to forecast recession. Declines in consumer confidence. The U.S. economy is mostly driven by consumer spending. Consumer confidence surveys that constantly show a decline could foreshadow approaching economic problems. Consumers who respond to surveys when their confidence is low are expressing a lack of confidence in making purchases. If they act on their anxieties, lesser spending slows the economy. Sudden stock market declines. Since investors frequently sell off all of their holdings in advance of economic downturn, a sharp, unexpected collapse in the market could be an indication of one start. So how will a recession affect us? As unemployment rates climb during a recession, you can lose your job. Because more individuals are unemployed, it becomes much tougher to obtain a job replacement in addition to being more likely to lose your existing one. Those who maintain their employment may see reductions in pay and benefits and face difficulty securing future pay hikes. Your savings may be reduced and your retirement plans may be disrupted by the investments in stocks, bonds, real estate, and other assets that experience a loss of value during a recession. Even worse, you can risk losing your home and other possessions if you are unable to pay your expenses as a result of losing your job. During a recession, business owners have lower sales and could even be forced into bankruptcy. It's challenging to keep everyone solvent during a severe downturn, but the government tries to help businesses during these trying times, like with the PPP during the coronavirus epidemic. During a recession, lenders tighten requirements for mortgages, auto loans, and other forms of finance as more people find themselves unable to make their payments. In more typical economic circumstances, you may need a higher down payment or a better credit score to qualify for a loan. Even if you have plans to prepare for a recession, going through one can be terrifying. Recessions do not continue forever, but there is one thing to take solace in. Even the Great Depression eventually came to an end, and after it did, the U.S. economy perhaps experienced its strongest expansion ever. If you enjoyed this video and want to see more videos on money, wealth, and finance, as well as tips on investments, kindly like this video and subscribe to our channel. Don't forget to enable the notification bell so that you will be notified whenever we upload new videos. Thanks for watching and see you in the next one.